Hello, everybody, and welcome to Public Live. I am your host, Kinsey Grant, and I am thrilled you're joining me today for what is certain to be an illuminating and informative interview about something that, and I'll be frank with all of y'all here, even I am still working on comprehending in its fullest form, in its fullest definition, its fullest strategy. So today we are exploring leveraged and inverse exchange traded funds, or ETFs. Like many investing options, leveraged and inverse ETFs can become an integral part of a more diversified investing strategy, but there's always a but. Only if you understand them completely, understand how they might fit into a larger strategy for your investing goals. So today, let's work on getting that better understanding. I'm so excited to do that with our fantastic guest, Dave Matza. He's the managing director and head of product at Direction. Dave, welcome to Public Live.
Thanks for having me. Excited to be here.
Of course. I'm excited to have you here today. And I think that a place that it makes the most sense to start with this conversation is just to kind of get those fundamentals, those building blocks, the basics. Can you explain to me what leveraged and inverse ETFs are, and especially how they differ from more traditional exchange traded funds?
Yeah, sure. So let's start with the more traditional exchange traded funds, which I'm sure some people are familiar with, but others may not be. And really, the ETF in the United States was first founded in 1993, and the idea was to create a diversified portfolio of securities. And originally they started with stocks, but they've expanded to bonds and commodities and all sorts of other asset classes and sectors and countries and everything in between that can trade on an exchange. So an investor could buy and sell them like they do an individual security, and you have that control that you didn't have historically with a mutual fund. And the other real benefit is the transparency. So the costs are the same, whether I'm buying one share or 100 shares or a million shares. I pay the same price as an institutional investor, which is to me one of the real benefits of ETFs. And then there's also these great tax efficiencies, which we can get into. The leveraged and inverse ETFs came around in 2008, and the idea was to democratize access to sophisticated strategies that only institutional investors could use, and that is embedding leverage in a product. And what leverage and inverse ETFs are is they provide daily exposure, and this is really important, to a particular index or area of the market, but on an amplified basis. So if we hear a bull fund, that's amplified upside exposure, a bear fund, amplified downside exposure. And what they tend to do is be at a 2x or 3x or even a minus 1x level. And that simply means 2 times the upside or 3 times the upside. But it's important, to note that these are daily tools. They're not intended to be buy and hold investments. They're really intended to be used as trading tools to complement other areas, other investments that folks may have.
So can you explain a little bit more the concept of daily trading? So often we hear experts come on and say that we should buy to hold, Warren Buffett perhaps being the most famous of all of them. But I'm curious if you can explain a little bit more what you mean precisely by daily tools for more of a daily trading strategy as opposed to a longer term.
Yeah, well, I would advocate, most people should be thinking about the long term and having particular goals, right? So maybe my goal is to save for retirement simply, or to save to buy a home, and the risk tolerance of those investments are going to be very different, right? So let's say I know I need to make a down payment on something. I'm probably not going to want to expose it to risky stocks, or even maybe stocks in general. And everyone's situation is going to be unique. But a daily trading strategy can be beneficial for folks who have the ability to monitor portfolios on a frequent basis. If you're not interested or don't have the ability to make buy, sell, and hold decisions on a frequent basis, these products may not be appropriate for you. But if you do, they can be used to complement longer term investment strategies. And so by that, I mean carving out a portion of one's portfolio to take advantage of short-term tactical moves in the market, whether or also to take advantage of opportunities to hedge portions of one's portfolio. So that's really what we mean by daily. So they're really tactical trading tools that can be used by investors and traders.
Yeah, that makes a lot of sense. And I'm curious here, with that in mind, if you could walk me through a little bit of how, a leverage or inverse ETF might fit into a specific, kind of investing strategy. You mentioned trying to make good on shorter term, more tactical moves. Maybe it's headlines, maybe it's specific, trends or market psychology type action in the market itself. Can you walk me through a little bit more specifically some examples of how ETFs that are leveraged or inverse might best fit into a strategy for any of the investors who are listening today who might want to either start or pick up the pace with their more daily trading strategies?
Yeah, so yeah, if you're a conservative investor or only interested in buy and hold, again, these tools these may not be the right tools for you. But if you're interested in trading, they can be very powerful, because if you have an opinion, and whether you're using fundamental analysis, meaning an opinion on semiconductors or financials, this would be an opportunity to amplify that view. Right. So I'm very bullish on an area in the market. I'm going to take advantage of this try to take advantage of this on a short-term basis. Or let's say I have a lot of exposure to NVIDIA, AMD, Intel, and all these other great semiconductor companies out there. I could use an inverse product to hedge my long positions. So for example, let's say we know that a handful of these companies are reporting earnings on a particular week, but I'm concerned that they might have some negative results, but I don't want to sell these companies. Either I have embedded capital gains or I just continue to like them. I could use an inverse ETF to hedge my position and not have to do so with shorting a security, which can be complicated, or engaging in various option strategies, which certainly can be beneficial, but also have added layers of complexity.
Thank you. Yeah, I think that's a great example. And, it brings to mind this idea of, you mentioned before that conservative or buy and hold investors, this might not be the best tool for those types of investors, but that's certainly just one category of what has become an increasingly diverse set of retail investors, like everybody listening to this live right now. But when it comes to leverage, we've so often heard the word leverage associated with maybe more magnified levels of risk. Good bets are made better, but bad bets are made worse. So for anybody listening to this today, how would you suggest that they, as investors, evaluate whether or not this kind of fits in with their risk appetite, or the risk profile that they're hoping to invest based on? Kind of with that as the second follow-up question here, how is risk exposure best managed in the smartest way possible with tools like these ETFs we're talking about today?
Yeah. So first and foremost, I would say, a willingness to learn, a willingness to learn more about these products. Part of which is listening in today, going to our website, taking the quizzes that we have about how these products work. Are they right for you? And as I said before, really the ability to manage positions frequently, so that you can take advantage of evolving and changing market conditions, because that will impact the performance of this investment in the fund, because these are index-based tools, but on a daily basis. So meaning, if the S&P 500 was up 1% and our 3 times S&P 500 fund SPXL, that would be up 3% on that day. So that's great. But what if the market was down and I was long that particular fund? I would be down worse. So if I don't have the ability to kind of make that decision, that these may not be the risk management tools for you. But because particularly these markets are so volatile, the opportunities to take advantage of moves have shortened, right? So this is something which two interesting things happen when volatility increases, particularly the VIX, which is a measure of equity market volatility. When it's above 30, that's a particularly volatile environment. And two things tend to happen. My horizon can lengthen and shorten. So if it lengthens, meaning if I have my buy and hold strategy, I actually probably shouldn't be as focused on short-term losses or even short-term opportunities. But I also can shorten my time span and say, well, hey, actually, there could be a near-term opportunity in energy stocks or financial stocks, or CPI is being released on Friday. Maybe there's certainly going to be some moves in the interest rate market. So I tend to think about risk management under different time horizons, and one of which is the ability and kind of effort to stay put, but also paired with what I would also say the ability and opportunity to take advantage of shorter term tactical moves.
All right. And you mentioned, volatility. I think that this is, obviously a word that we have become increasingly familiar with over recent months, especially as investors. But I'm curious, with that in mind, if there are any specific kinds of market conditions or environments in which leverage and inverse ETFs have historically performed better than more traditional ETFs. Is it market up, market down? What kind of trends or conditions or environments are you most looking for in terms of making the most of a potential investment in a leveraged or inverse ETF?
So what's interesting is in a upward trending market, a leveraged ETF, a bull leverage ETF will likely do exceptionally well. The challenge is that having the foresight to identify that tech was going to go on a 10-year bull run and have exceptional 3-year returns before really kind of falling back pretty hard starting in November of last year. So that's an environment where a bull fund would do great, right? In a bull market. A bear fund would do great in a one-way bear market. Where these products tend to not do well is in a real choppy and trying to buy and hold them in a choppy market. And that's why we really advocate against using these as buy and hold tools. But if someone wants to trade these products and say, hey, this look based off of my research, we may be seeing oversold conditions. That's something where then I would, maybe look to take advantage of a short-term bullish move. Or if my indicators tell me, hey, maybe maybe the opposite is true, then you could use an inverse bear fund to protect portfolios. So the answer is, I think a lot of folks think about investing and think about even trading that, there's got to be one clear cut answer for all these environments. And that's not necessarily true or the case. And that's okay. These tools are really there for people to take advantage of up and down moves accordingly.
And we have certainly had plenty of up and down moves over the last couple of months. It's been quite the departure from the up and to the right and just up and to the right that we'd gotten so used to for so many years before this last couple of months. But I want to talk now about some of the options that people have if they're interested in some of Direction's products. I understand that you just launched the Breakfast Commodities ETF. So I'd love if you could explain what it is, how it works, and what the fund tracks.
Yeah, happy to do so. And what's interesting about the Breakfast Commodities strategy, and the ticker is BRKY, BRKY, is that it's actually not a leveraged fund. And the reason being is that commodities are inherently a volatile asset class, but they can be used as longer term buy and hold investments. And for years, in fact, decades, most investors, whether they're institutions or retail, have been underexposed to commodities because they haven't done quite well and people weren't interested. That's all changed. We're in an environment where when you go, I have 3 kids and they're 4, 5, and 6, and they're girls, but going to even buying cereal for them and eggs has gone up markedly. And I think everyone is feeling that. So the breakfast commodity strategy is a way for investors to protect their portfolios and take advantage of rising food prices, in particular, the kind of staples that we all eat. So the fund tracks an index of 6 commodities that are firmly related to breakfast. So and we're working with an index provider called S&P to develop that. And I think it's really beneficial that folks can look at this and use that to our advantage. So we designed it to have exposure to corn, wheat, sugar, lean hogs, which is your bacon, wheat and orange juice, because those are really the core elements that the staples really in a breakfast. So and the UN releases an index of food prices globally, and it's at its highest ever level ever in the history of this particular index. And I think it's because everyone's feeling it, we wanted to create a tool for investors to take advantage of that and really diversify their portfolios at the same time.
So it sounds to me like this is in many ways, if not, a direct hedge against inflation, perhaps an answer to the inflation that so many people are facing. You mentioned just going to buy food. I went to the grocery store this morning and was astounded at the price of everything. I think everybody has probably experienced something like that. I'm curious about how your expectations for this ETF, this breakfast commodities ETF, might change if the Fed does get it right, if inflation does come down from the highs that it's at right now. What's the future look like for this fund in a less inflationary environment?
Well, I think, what's interesting is that we are very focused on inflation. Like it's on the national news, right? So you don't have to be on a conversation like this or financial media to be talking about rising prices. Everyone's feeling it at the pump, particularly at the grocery store and restaurants when you get that bill. And what's interesting here is that particularly breakfast commodities, and commodities are a bit misunderstood. And I always think about the movie, it's from the 80s, but it does hold up if folks haven't seen it, called Trading Places, which is about, it's on one hand, it's a holiday movie. On the other hand, it's a movie about finance. It's a little bit of everything. Dan Aykroyd, Eddie Murphy, but in it, they talk about the staples component. So there's stable demand for these foods, right? So there's generally stable demand for wheat, corn, to some extent sugar, but what's unique here is the supply side. So even if we see headline inflation come down, and some are predicting that to be the case on Friday, then with the most recent CPI report, even so, the supply of these commodities remain constrained, right? So we know that Ukraine is the breadbasket of Europe. Without getting too deep into that, that there are obviously supply constraints for wheat has fallen. There's issues with coffee production in areas like Brazil, what have you, because of drought. So the group of commodities that are agriculture in particular associated with breakfast have really stable demand and they're facing supply challenges. So, which is one of the reasons why this thesis of investing in breakfast commodities has longer legs than even if the Fed is able to thread a very tight needle here.
All right. And of course, we will be watching to see if they can successfully thread that very tight needle. But certainly interesting to understand how this ETF might fit into really any environment, inflationary or otherwise. So thank you. Now, with that, we've covered a ton of ground today, Dave, and I just want to understand a little bit better if anyone listening to this who is either listening live right now or later in the public community wants to dig deeper and try to educate themselves a little bit more on leverage and inverse ETFs. Do you have any specific resources that you suggest?
Yeah, so feel free to go to direction.com, and direction, it's spelled a little funny. It's DIREXION. And there at the top of our page, whether you're on mobile or on your computer, you're going to see it, an education and insight section. And there's a few things there. So there is where, I'd recommend folks watch the videos or read the articles that we have on leverage and inverse education. And then if someone's interested in learning more about a specific product, that's when, we have further information at the product level. And what we do purposely is we break out the leverage and inverse family of funds, and then kind of the more thematic, longer term buy and hold products like the breakfast commodity strategy we talked about.
All right. And I appreciate that, Dave. I have been taking some pretty diligent notes, and I'm excited to do a little bit more research. And it's been great to understand these products a little bit better with you today. Dave, I really appreciate your time. Thank you so much for coming on Public Live today and explaining to us all about leverage and inverse ETFs. The title really says it all. We got the 101 here. I'm excited to do some more homework and come back for the 202 shortly. But thank you so much for joining me today.
Thanks for having me. Look forward to chatting again soon.
Yeah, absolutely. And thank you to all of you out there for listening today. I hope you learned as much as I did. And I hope you also have a fantastic rest of your Wednesday. I will see you guys next time.
If you would like to see more content like this, subscribe to our channel and download the public app where you can listen to these sessions in live time.